Hey, it's Akhtar Khan from Reaching Excellence, and in this video I'm going to share with you 3 ways that you can raise money to do buy-to-let property investment. So stay tuned. Hey, it's Akhtar Khan. So in this video I want to share with you some ways that you can raise money. It's a question that I've had a lot this week. I've been doing some podcasts and I've also done a few talks online, and people have been coming back to me with private messages saying, look, I want to get started. How can I raise money to do property investment, buy-to-let deals, etc., etc. So let's talk about the 3 ways that you can do this. Okay, now the first thing I want to do before we get into that, I want to give you a mindset shift. Now, when I started out in property, which was 1992, it took me 10 years to get on the ladder, and the reason for that was because I was saving up for deposits. I was saving. I was a little bit young and a little bit stupid, didn't really know how to manage money properly, and I wasn't that serious because of the phase of life that I was in, but it was a belief that I had to use my own money. Okay, I later discovered that you don't, and I'm going to share with you how you can use other people's money, lending from banks and institutions, but also private finance. Now, if I knew what I knew now, hindsight's a wonderful thing, and I did what I do today back in 1992, I'd have even more property and I'd be even wealthier. Okay, so look, guys, the first thing you can do is utilize your own cash. Now, if you've got savings or you've got income coming in from a business, you can utilize that for deposits. Now, typically, what you will require for a buy-to-let property is 25%, and you can go to the bank. At the moment, we've got great mortgage products available, very low interest rates, and you can typically borrow 75% of the balance that you require to buy that property from a buy-to-let lender, okay, a mortgage company. So you need 25%. The bank will give you the rest of the money as long as the deal stacks up. So what do I mean by that? So stacking up means that it's stress tests. Stress test means that if the interest rates were to go to 5%, would the rent cover the mortgage and have some surplus? And then typically the rental coverage, which is normally a percentage that the banks would say the rent needs to cover, like 125, 135% of the mortgage. Okay, so that basically there's enough meat on the bone, there's enough profit for it to pay for itself. So as long as you fit that criteria, you shouldn't have a problem getting buy-to-let mortgages. Okay, so using your own cash is great, but here's the problem. Doesn't matter how much cash you've got, eventually, if you're going to keep using and utilizing it to put into properties, dump into properties as deposits, you're going to run out of cash. So the second thing I want to talk to you about is how other ways of raising money, but also I want to give you a different business model of doing things. So the second way you can do stuff is you can use, if you've got an unencumbered property, let's say your main residence has got no mortgage on it, or it's got a very small mortgage on it. Sometimes you can go and refinance that and go and take some of the equity out of your home, and you can utilize that money as deposits for more buy-to-lets. The second thing you can do is you can go and get what's called a drawdown mortgage. What does that mean? It means, let's say your house is worth £200,000, okay? You can then go to the bank and you have a facility where you can just take the money to a certain percentage. You know, maybe you can take £150,000 of the £200,000. You can take that money and put it into your bank account. And then what you can also do is when you've used that money, if you want to pay it back onto the mortgage, you can pay it back. So it's almost like you have an overdraft type facility, but it's based on your house. It's a mortgage. It's called a drawdown mortgage, okay? Third thing you can do is there's certain bridging companies or bridging finance companies that will allow you to have a drawdown facility against an unencumbered property. So what is bridging finance? Well, bridging finance is short-term finance. Bridging finance is typically used for properties that are not mortgageable, you know, properties that have been damaged, very dilapidated. Also you could use them for buying properties through auctions and commercial properties and so forth, okay? They have a much less stringent criteria for the condition of the property, but it's normally short-term, anything from 6 months to 9 months, 12 months maximum, I think. So that's what you could do. That's using lending facilities, okay? The third thing is using other people's money. Now, there's a lot of people out there that have got money that's sat in the bank that is idle, lazy, and that money will devalue if it's sat in the bank because of inflation. So, you know, there's people out there that don't have the skill, that don't have the knowledge, that don't have the drive, perhaps even don't have the energy to go out and do what it takes to do property deals. So you could be helping those people. And one of the things I want to get you guys to think about, and again, this is what I teach my private academy members and my mentees, is that you're not going there with your cap in hand begging and asking for money. What you're actually doing is serving these people, because you're giving them a fixed rate of interest on the money that's going to be sitting in the bank, that's going to be far better than what they're going to get in the bank anyway. So typically we give people anything from like 5 to 10% interest on their money, and this is done by what's called a simple loan agreement. So they lend you the money, they lend it for a period of time, and then you give them the money back with interest. So to make this work, I've got a model which I teach. It's called the 4M's Property Success Model. What we'll do is at the end of this video, we'll give you a link to a masterclass so you can go and watch that. Now, one of the things that I teach my students to do, and this is what I do with my own business model, is I'm looking to buy property below market value. Given the current climate with this whole pandemic and COVID and the recession that we're in, there's going to be more and more motivated sellers. There always is. Confidence becomes low, unemployment becomes higher, property market begins to slow down in places. You're going to find people that will be willing to, especially if they're motivated, if they've got financial problems, if they've got health problems, if they need to relocate, sometimes them selling their property causes another pain in another area of their life. And it's not always about price. People are willing to forfeit price or lose some money in order to get a quick guaranteed sale. They want the certainty so they can move forwards. So what you're looking to do is to buy below market value. Now, it doesn't matter like if you get a small discount, if you get a few £1,000s off, that's great. When we get into the midst of recessions, you can get bigger deals and bigger discounts. Now, I just want to set your expectations here. Like if you can get 5% or 10% off a property deal, that's great. I've actually had on some cases, typically I look for 20, 25%. Doesn't always happen. The biggest one I've ever done is 49% below market value. Now people say to me, why on earth would someone sell a property below market value? Simple reason, it's because they have to. Now, and I'm not saying you're going to go out and get discounts as big as that, but you can get discounts. And what you're looking to do is to make your money when you buy. So you've got some meat on the bone. That discount, you can utilize that later on, i.e. you can go and refinance and pull that money back out, okay? The second thing you want to be doing is value engineering, adding value. So what does that look like? Typically, people will go and buy a property, they'll refurbish them, then they'll refinance them. So you can take a property, let's say it's £100,000 to buy this property. I'm just pulling numbers out of the air just for illustration's sake. You spend £20,000 refurbishing it. The bank will then go back and reevaluate it at maybe 150, 160. What you're then able to do is to pull the bulk of your money back out, which is your deposit, the money you spent on refurbishing it, and a bit more, as long as the numbers stack up. So what does that mean? What do the numbers stack up mean? Well, when it comes to getting a buy-to-let mortgage, the banks want to see two things. They want to see rental coverage, and they want to see what's called stress testing. Now, at the moment, interest rates are very low. So what they want to do is to see that if the interest rates went back up to 5%, would the rental income still pay for the mortgage? Okay. And the second thing is typically they want to see a rental coverage 125% or 135% of the rent basically covers more than the mortgage itself. Okay, so typically what you're looking for is, let's say the rent is £1,000 a month. They're looking for you to have the mortgage is £1,000 a month. They're looking for you to have something like £1,250 or £1,350 in rent coming in, so you have enough of a buffer and enough profit margin. In essence, what we are looking to do to grow your portfolio successfully is buy below market value. You want to be adding value or creating value or value engineering, and typically people do refurbs. It's a strategy that people have been doing for a long time. I also like to look at how else can we do stuff. Can we reconfigure the rooms? Sometimes I've been in properties where the rooms have been poorly modeled out. Sometimes you've got a basement which is not like a full basement. It's kind of, there's windows in it, it's half at street level, and you can turn that into a room or a bedroom. Other times we've got garages which aren't really good as a garage. You get the car in, you can't even get out the door. They're about 8 foot wide. UK garages are quite small typically, but you can convert that into another bedroom. Again, this is all going to add value. So we're looking to buy below market value, value engineer, and add as much value as we can so we can recycle and pull our money back out. Like I said, at the end of this video, we'll give you a link to that 4M's masterclass. We can go and watch that and learn that business model. This way, what you're going to do is, as long as you follow this business model, what you're going to do then is you're going to be able to create enough equity so you can refinance and pull money back out. And if you're going to use other people's money, that's how you pay them back. Now, typically what happens is when you use private funds, once you've paid an investor back, and then you give them money, they go, great, thank you, I've got my interest back. Do you want to take the money back again? So I'm a big fan of using private funds, private investors. A lot of the time when people say to me like, oh, this is great, but who's going to lend to me? Why would they lend to me? I haven't got a track record. I haven't got the experience, and etc., etc. Well, as long as the numbers work and you've got the right support, if you've got someone who's guiding you or someone who can confirm the deal that you're doing is a good deal, people will still lend money to you. Okay, it's down to them to make sure that, you know, they're happy with the risk, and it's down to you to provide them with the evidence that what you're doing is a good deal. You're not buying something in the middle of nowhere. You know, you want to be looking for stuff that, you know, you can refinance and pull your money back out. And also, one of the things I think is really important, you want to be buying in areas where there's good capital appreciation. Don't be buying stuff in like remote towns up north where, you know, unemployment's high and you haven't got that opportunity. What you're going to be doing is in areas where there's good capital growth. So if there was any problems and you got money stuck in the deal, which sometimes happens, you know that you can wait and it's going to go up in value. You can pull money back out and recycle your cash quicker. So guys, look, there's 3 ways there that you can utilize to fund your deals: your own money, lenders and lending institutions. You can leverage the equity in your own home, and other people's money. So do me a favor, in the comments below, let me know what you have been doing before, or what ways you've thought about in terms of raising money for deals. Also, like and subscribe. We're going to be sending out more videos each week. You know, make sure you subscribe so we can get notifications as to when they come out. Hope you found this video useful. I look forward to seeing you and sharing more stuff on the next video. Take care. Bye for now.